my right hand, I have $1 million. And in my left hand, I have a penny doubled every day for a month. So I'm going to ask you which one you want. And that turns into $10.8 million in 30 periods, 31 days. That's the effect of compounding.
Using his deceptively simple 3-step process to evaluating companies, he's beaten the market for nearly 30 years and an annualized return of 17%. So how did an English major with no investment background go on to build one of the most prolific investment records and a $17 billion fund by focusing on only what matters? Let's hear Akre break down what he looks for.
The requirements for a great business for us have really 3 components. The first is we spend a lot of time trying to understand what's causing this above average return to occur. Is it getting better or worse? The second thing we look for are the people who run the business, and not only do we want to have great business managers, but we want to see to it that they treat public shareholders as partners, even as they don't know them. And then lastly, we look to see if there's a great history of reinvestment of the free cash flow, as well as a significant opportunity to reinvest free cash flow and earn above average rates of return. Those are the characteristics of the business.
These 3 rules form the basis of Akre's investment philosophy. Let's break down each of these and find out what kind of companies Akre actually invest in.
We like to fish in the pond of high return businesses. And so it makes it much easier for us to get our focus up front.
First and foremost, Akre looks for companies that can produce above average returns on the owner's capital over a long period of time. What does that even mean? Specifically, he's looking for companies that can get 20% return on every dollar that they reinvest into the company. By comparison, most companies in America get between 6 and 8% for every dollar they choose to reinvest. So this is a huge margin. The beauty of his approach is that the return on capital for a company is equal to the stock of the company in the long run. He finds these companies by looking for their secret sauce.
It's my sauce. I make it myself.
Or what Warren Buffett would call the moat. The moat could be one of many things. It could be a patent, the low-cost production of a certain product, the scale of the company itself, or just lack of competition. Moats aren't always obvious, especially early on. For instance, take a look at Microsoft, arguably a company with one of the widest and most profitable moats to date. Microsoft essentially became the toll road upon which much of the digital revolution was built. Despite that, even Bill Gates didn't know how extraordinary a business he had in the early 1980s. Bill Gates tried to sell the company to IBM early on. Luckily, it didn't work out. So having an extraordinary business is extremely important for Akre. But you know what matters just as much?
The shorthand version of that is we want them to have both skill and integrity. But what we say is that they've got a demonstrated record of being just killers at operating their business. But in addition to that, they treat us as partners even though they don't know us.
Even though an extraordinary business is important when finding a compounding machine, it needs to be accompanied by a team with skill and integrity. So how do you know whether a team has skill and integrity? 1, they demonstrate that they have skin in the game. 2, they pay themselves fairly. 3, they are accountable to their shareholders. You could take these 3 points and see how some of the best teams in the world embody them in places like Berkshire and Apple. On the other hand, let's look at an example of a great business with poor management, specifically Hasbro. Hasbro, the toy maker, also owns Wizards of the Coast. Wizards of the Coast is one of the premier high-margin businesses out there today. They own the IP for Dungeons and Dragons as well as Magic the Gathering. Both of these franchises have massive followings that spend large amounts of money on this business. Despite having this great business, Hasbro has not been able to eke out a positive return in the last 5 years, even as this segment of the business has seen massive growth. So how does the Hasbro team stand up to Akre's rules for a team with skill and integrity? Do they demonstrate skin in the game? No. Hasbro board gets paid more than Apple, but has not bought a single share of stock in the last 10 years. Rather, the management has been paid out over $180 million over the last 5 years. That takes us to the next rule. Do they pay themselves fairly? Despite the terrible performance of Hasbro stock over the last 5 years, the CEO continues to earn more and more, earning $17 million most recently this year. So is Hasbro accountable to their shareholders? Despite lagging behind major competitors like Mattel, Hasbro does not even acknowledge its lagging status. Management was recently proud to tell investors that they expect no earnings growth in 2022, whereas Mattel is expecting double-digit earnings growth in 2022. As you can see, a good team can make the difference between a good investment and a good business. The last leg of Akre's investment philosophy is reinvestment.
And if a business has a great high return on the owner's capital, we would love for them to be able to take all the free cash they generate and put it back into that business to continue to earn those high rates of return.
So how do we find a company that satisfies the reinvestment leg of Akre's philosophy? One, it has to show a history of disciplined reinvestment. And two, it needs to show extensive future opportunities for the company to reinvest its cash or acquire other companies. When it comes to history of reinvestment, for example, you can look to Berkshire Hathaway. They have a history since the 1960s of being able to reinvest with really high rates of return despite massive scale, making it more and more difficult by the day. Ideally, Akre looks for companies that can reinvest almost all of their cash back into the company at those high rates of return that we started off with. The reason for this is that this is much more tax efficient as compared to returning that cash to shareholders. As I showed in my video about Manish Pabrai's spawners, the tax benefits of companies that are able to reinvest their cash back into the business are astronomical. Often companies can save 50 cents on the dollar for every dollar that they reinvest back into the company versus giving it back to shareholders. So now that we know what type of companies Akre likes to purchase, when does he sell them? Surprisingly, Akre prides himself on not having any sell targets for his companies. As long as a business continues to have all three legs of investment, he will rarely ever sell. This is because it's really difficult to find these compounding machines, and much of the value of compounding comes later in the company's growth. If we take Akre's example of a penny doubling for 30 days and work backwards from $10 million, it only takes us 5 days to get below $1 million from the $10 million starting point. Hence, you can see how the vast majority of the return in a compounding machine comes in the later stages of owning that company. As a result, you can see how no matter the state of the market, an investment in an Akre compounder at a fair price is hard to beat. Thanks for watching. If you enjoyed this video, you'll love my video about Manish Pabrai's spawner framework right here.